guys, in this video, instead of making a bunch of predictions of what the market is going to do in the next 30 days, 90 days, 180 days, look, I've done it in the last video, and some of you missed an easy 8x trade, meaning for every 5K you would have put in that trade, I mean, you would have gotten back $40,000. So pay close attention. I'm actually going to talk about the stuff that really matters when you trade. We're going to get down to specifics. And I'm actually thinking about making more videos like this because I think the more examples I am going to give you, the better the chance that you will actually recognize some of the mistakes, some maybe psychological aspects that will allow you to break out to the next level. So the subject of this video is what I believe the subject that you should study a lot more as a trader, and that is the strikes. The strikes that you select, okay? And specifically, the underlying idea is that bad strikes, when you're trading options, especially weekly options, they will kill great trades. So you may have an idea for a super great trade, and you're excited about it, and maybe even got a great entry, and fuck it. It expires worthless, okay? So bad strikes kill great trades. In other words, the stock is doing exactly what you expect it to do. It drops or it goes higher, but because of the reason that you've selected the strike that maybe was a little too far out, okay, you're not making the money. So I'm going to show you about 4 different examples, 4 different trades that we're taking with traders this week. And if you want to learn more, simply visit 13mmtv.com, guys, and get this stuff under your belt, because this is your bread and butter. When you're trading weekly options, okay, understand that maybe you're actually a good trader, okay, but you're losing money. And you can tweak a few things that will actually start having your account produce. Like, instead of red, guys, you're going to start seeing green. I promise you. It's the bad strikes. So let's glance at a few examples to bring some light here so you can get better. Okay, so remember, in the last few videos when I was talking about psychology, I said, look, as a trader, you got to cut out the noise. You got to focus on 3 things. 3 things, the only 3 things that really fucking matter when you trade. It's entry, strike, exit. Okay, so bad entry, I mentioned in one of those videos, one of the last 5 videos, bad entry could be compensated by a good strike, okay, but not the other way around. So basically, you can miscalculate your entry. Oftentimes, especially if you're trading high volatility stocks, like Amazon or something, like, they're going to do an overshoot. They're going to do an undershoot. So when you're trying to pinpoint an entry in a stock that's, you know, $3,000, $3,500, right? I mean, you're not going to nail your entry down to $1. At times you will, but it's not going to happen every day. So understand that the trade will move, oftentimes temporarily, against you. And most of you that set those stop losses, I mean, if you're trading stocks, it's okay to set stop losses. But when you're trading weekly options, okay, and you set stop losses, you're fucking yourself. You're fucking yourself out of big profits. And so if you don't understand this, maybe you've been brainwashed by a lot of, well, learn how to risk manage your account. And, you know, all of these guys, please, fucking ask them. They don't make any real money. Yeah, anybody can tell you, well, only put 1% of your fucking account in the trade. Okay, good luck with that if you got $1,000 to work with. You'll never make any money. Your account will never move anywhere, okay? Please don't be the guy that's sitting with a $1,000 account and 30 fucking trades, okay, by putting $50 in it. Guys, it just doesn't make any sense. So, let's move on. I'm getting a little sidetracked here. The point is, okay, bad entry, okay, oftentimes could be compensated by a good strike. And what is a good strike? Well, a good strike, clearly, I mean, if you had the money, if you had all the money in the world, you'd just be buying stuff all the time in the money. Okay, they're not going to produce no 4 or 5x returns, but hey, I guess it's okay if you make 10, 20% in the trade and, you know, you invest in $100 million in the trade. I guess it's all right. But most of the guys that are involved in trading, I mean, you're probably working with a 10K account, 20K account, 500K account, million account, I mean, what is it, 10, 20%? That's nothing, okay? We're talking about peanuts, okay? So you can be all the time taking trades that are making, 10, 20%, because even if you're buying stuff deep in the money, there are going to be instances where these trades are going to go against you. Even if you got a lot of experience under your belt, just basically understand this. Just buying stuff in the money all the time because it's safe, number one, is lowering your potential to make a lot of money in the market, because there are clearly conditions when you should be buying options way out of the money, and they're going to be your 2,000, 3,000 percentage. You just got to understand the conditions and when you should do that better, okay? And we should clearly just steer away from doing that, okay? But overall, okay, it does make sense to utilize the strategy that I'm about to show you. So let me get down to this example right here. So this is Amazon, okay? Amazon historically got a support level just under $3,000, and so on Tuesday we actually sent out the alert to buy 3,050, 3,000 strike puts in Amazon. So there it is, triple top. Okay, there's your tornado pattern right here, and boom, there it is. Okay, it gaps down yesterday to 29.92. All right, and so this was an easy, guys. This trade was so beautiful. But clearly, when you trade in options, the cost of option is what's going to determine whether you're able to put a 30x trade, or whether you're going to only be able to do it like a 3x trade. And so this was a beautiful trade stock-wise, meaning, hey, this is a 100-point drop that we're capturing on this trade, and the entry is perfect, okay? But the cost of option is so freaking high that if you're working with a small size account, okay, one option costs you $2,000. Okay, great. That same option would have made you, $7,000. But most of you would have never taken the trade. Why? Well, because of this mentality that, damn. My whole account is $3,000. Leah, you want me to buy one option for $2,000? I would never fucking do that shit. Okay, so if you're that guy, okay, think twice about this psychology of what you're really trying to say. Okay, I'm suggesting you buy quality option on a quality product like Amazon, which is a high quality product for trading options. If you can understand the charts and the moves in Amazon, you will make money all the fucking time in Amazon. It's not very hard to do. It's just if you're working with a smaller account, you're missing out on these high payout trades because you're not ever considering buying one option for $2,000, because you'd rather buy and go chase some $10 stock where you can buy 100 options for 20 cents. And there's nothing wrong with that. With the exception is, that's not a good strategy if you're trying to build an account and if you're not sure exactly how to time it. Now, there's clearly times where you should be doing that. I'm actually going to show you an example in just a moment of when you should be utilizing such a strategy. So fast forward. So this was like a 4x trade, no big deal. And I've gotten some new traders. I was getting in right here on Wednesday, okay, at the same level, right? So when Amazon hits 3,080, 3,070, I get a bunch of my guys in right here at this level. Well, notice what happens, right? I'm suggesting look at the strike price that I'm actually suggesting. I switched my strike price for a reason, right? So we actually locked some gains. We sold half of the puts here, and then now for the guys that have been in the trade since here, we're adding here more puts. But for the new guys that are just coming in, we're actually giving them this recommendation right here to actually short these puts in Amazon at this price level. But notice, I'm no longer going with a 3,000 strike. I'm going with a 3,080, 3,070. Okay, why? Well, there's a clear pattern here, and so we're at the same level. There's a reason why we're shorting at this level, because the probability that, hey, Amazon is gonna move above that level is just not very high. Okay, and the probability it could possibly revisit some levels closer to this low that was set on Wednesday morning, it's high. It is extremely high. especially if you listen to all the market conditions I have described in this 1 hour long video that I posted like a day ago. So notice the switch in the strike price, that's what makes you the money. I'm no longer going here with this way out of the money. Here I was. It was a Tuesday. Based on the pricing of the options and the levels, it made sense because there was a high probability it was going to pierce that 3,000 level, so we went as aggressive as that. But here, we switched the strike, okay? And look what happens. Even with a good strike like that, remember I said that a bad entry, which in this case, it turns out to be a bad entry. Can you fucking believe it, right? You got a quadratop here, okay? You've got, you know, no volume on the way up. You got pure divergence on the volume here, and here we are. We're shorting the hell out of Amazon right here, and then what does it do? It fucking goes higher. So you're sitting there, well, shit. Okay, it's going higher. The trade is going against me, and guys, you cannot listen. If you're setting stop losses, you would have been stopped out maybe what, right here? Something like that. You would have actually taken a loss on this trade. And so understand this psychologically, you have to 100% stay committed to your trading strategy. You have to stay committed to the 13 market moves if that's the plan that you're trading. If you're trading 13 market moves with us, you cannot deviate from the plan. Otherwise, you will have losses. And you can't. So a guy that bails out right here, and a couple of guys are like, oh my God, Leo, it's so fucking green. I'm like, fuck you, okay? Okay, be a pussy, jump out. So they did. And now they're like, oh my God, I could have made all this money. Yeah, motherfucker, be committed. Be committed to your strategy 100% of the fucking time. Don't be changing your mind just because something shoots over 20 bucks on a $3,000 stock. How are you ever going to beat the market if you're going to be doing stupid shit like this? That's what pisses me off. A beautiful trade, beautiful setup, easy money. You jump out because your heart started beating a little too fast. Okay, your wife is on your ass. Honey, the trade looks like it's going negative. Listen. I'm the fucking man in the house. I'm going to make the decision how I'm going to trade. Now, get back in the kitchen and fucking make me some coffee, damn it. Leave the man alone. If you can't even tell your wife to leave you the fuck alone, you trust your wife to babysit your kids, you trust your wife to go grocery shopping, she needs to leave you the fuck alone, she needs to trust you with the way you trade it. But you got all these pressures, your wife on your ass, you got all these bullshit, no wonder you're going to be jumping out right here. Now you got to leave all this bullshit aside, and if your wife and your husband are trading and you're listening to this shit, okay, I'm going to tell you, leave your man alone, trust him. By causing all this bullshit on your man, you're going to cause him to make mistakes. He can probably do a way better job if you just stay the fuck away. And that's the real shit. You want a new house, you want a new kitchen, you want to go shopping, leave your man alone. Damn it. All right, now that we've gotten that out of the way, so you see we're talking about the strikes. 3,080, 3,070 puts. Okay, this is what we've got. And today they're producing. Now, I ain't going to brag. This is no rock star trade. I'm sorry. I mean, depending on exactly what your entry level was, you did like double, triple the money and nothing to brag about. Okay? Now, the truth is Amazon actually had a chance to revisit this 29.90 level. We did partake in some action right around here, 3,060 level. We took some shots, 3,040, 3,030 strikes, even 3,020, depending on the strike. Again, right? I mean, this is exactly what we're talking about. Your strike makes or breaks the trade. It looked like the stock is dropping. Hell yeah, it's dropping, okay? But depending on whether you had this strike, this strike, this strike, or this strike right here, or this strike, it would determine whether you would have made some money, okay? And, of course, clearly, it would have been determined by how much you paid for your option. No matter how much you would have paid for any option below 3,030, it would have expired worthless. But based on the momentum and the pattern, what the market was doing, guys, we could have gotten easy, a revisit of the prior lows that we recently set just 24 hours ago right here. So these options could have produced huge. So if you're working with a larger account, you could have easily bought as a risk management strategy, you could have easily bought some options, let's say with a better strike like 3,060, 3,080. You could have bought some strikes that were 3,030, 3,020. So even though these strikes right here would have lost the money, these strikes right here would have definitely made the money, and overall you would have had a nice payday regardless. Okay, so I hope you understand as we progress through the week. We're talking about weekly options here. The strike prices need to be adjusted. Whether you adjust your strike prices will determine how much you will make, whether you will make the money or not. Okay, and so oftentimes bounces will happen in high volatility stocks. The market is doing some goofy shit right now. We should have never ever had this bounce in the market. We did get it. Okay, it's an oddball. There was like 5% probability that the market was going to bounce yesterday. It did the same shit the week before on Thursday ahead of the Friday. And so, you know, this is not a high probability move. So overall, okay, you want to stick with the bounce. You see, short the bounces. It could still do this overshoot right here, but you can still come out way ahead if you just stick with the move. If you understand the move, you can still come out way ahead on these trades, guys. Okay, so let's break down an earnings trade. Okay, BLK. So we suggested buying right after the earnings announcement right here. Okay, and I should really cover this part of the chart so to make this sort of a challenge if you're trying to learn, but just pretend, let's just be honest 100% with yourself, pretend that you can't see this part of the chart. And so BLK, now of course a lot of analysts are like, oh my god, you know, these banking stocks, they're the best deal in the world right now, we should be buying the hell out of them, what a great buying opportunity. Like, understand this, these guys, the traders on CNBC, okay, they don't know how to look at the chart. If you show them a chart and you ask them what the fuck is it, they're probably going to tell you, well, that looks like my baby's heartbeat. My wife is pregnant. When we went to the fucking, hospital to get a checkup, they showed me this MRA, and it looked like that. You know, these people are clueless. I mean, you're talking to traders on CNBC that are absolutely 100% clueless of what the chart is doing, or I mean, you can't be listening to the news and making money, guys. Okay, you got to learn how to read the charts. And so I don't have time to show you this in this video, but if you go and look at a longer time frame chart on any bank, JP Morgan, Goldman Sachs, BLK, okay, Bank of America, you name it, they all have a highly bearish chart and a very, very definite pattern. A pattern that is so fucking definite, okay? You know, you can have a brain damage and still get this trade right, okay? So you got a bounce, what happens next? A drop. A bounce, what happens next? A drop. The company announces earnings. The earnings seem to be good. But damn it, didn't we know already that their earnings were going to be good? So some goofballs are buying it, and you might have been tempted, oh yeah, I listened to the CNBC bullshit. The earnings are great. Okay, it doesn't matter how good or bad the earnings are. The only thing that matters when you're a trader is the reaction of the market to the earnings. So you want to bet, write this down, put it in the fridge, you want to bet against the initial reaction of the market. So the initial reaction to the earnings report is what? Stuff is moving higher, okay? And you should understand that you should bet against the initial reaction of the market if something is moving higher on lower volume, which was exactly the case here. So you might have been tempted, oh hey, if you're watching this video and you're really trying to make sense out of the market, maybe you even bought calls right here thinking the stuff was going to go to the moon. Well, no, we didn't tell you to buy calls. Hell no. Why would we tell you to buy whole calls in something that's got a 98% probability of a further drop? So we told you to buy 720, 715, 710 puts. Now notice, when it was bouncing here, okay, you got to look at the entire sector. You got to look at exactly what the entire sector is doing. So JP Morgan was down a couple of points. You had Goldman Sachs that was down, but it was shooting higher. You got to look at the overall sector and what's going on. So basically what I'm trying to reference here is there were no big size move. There were no big responses to any earnings reports that day that were coming out of the banking sector. And for that reason, Okay, if you don't see any big moves or you don't see any big volume, you should not be going way out of the money. Even though historically on BLK it is capable of doing $40, $50 moves, okay, after earnings. Now, those sort of $40, $50 moves were normally in BLK when it was trading about 900, 950 bucks, okay, at a much higher level. So percentage-wise, a 40, 50-point move in BLK would be much smaller than a 40, 50-point move right now. So generally, we'd want to take our expectations down when something is no longer trading at $900 or $1,000, when something now is trading at just above 700. So a reasonable expectation would be 20, 30 bucks. Therefore, understanding the size of the move that something could produce, you wouldn't necessarily go in with 680 puts or 690. You wouldn't even go necessarily with 700 puts. I've got a new guy who started trading. I'd send him a message. He's got a small account. I'm like, listen, you got to do the best you can, got the best option with the account size that you've got. And I told him specifically to just buy one. Okay, so buying one option right here in the 720 or 715 strike would have produced much better, greater results in this strike. Now, he was looking at this trade and is like, well, Leo says this thing is going to drop, okay? So he was like, okay, I'm going to buy multiple puts in 700 strike. I didn't tell him to get 700 strike. I said, get the best possible strike that you can afford with your account size, okay? And so that would have been for him like a 715, 720 strike. Instead, he went and bought multiples of in a 700 strike. Now, those clearly did not produce. He would have made a lot more on one contract of BlackRock than on multiple contracts in a 700 strike, okay? This is just understanding, okay, what the move can be. And guys, just let's forget about this example entirely. If you're a trader and you're trading often, you don't want to select like an even strike price like a 700, because oftentimes what's going to happen is kind of like what was happening right here. And this could have been the end, and he could have just completely lost this trade, but it had a second leg lower, and it was beautiful. But basically, you see how it dips. Like, this is your 700 price level on this thing, right? And you see how it dips just under. So a lot of times what institutional investors are doing, they will be sitting waiting to buy, right? And they're like, okay, well, 700 is likely to be the floor. This is the level that we want to buy. So anything just under 700, we're just going to scoop it up. We're going to buy the fuck out of it. And so something like a 699, 698, 697, they're buying. And oftentimes that's what's going to happen. It's going to resolve into like a spike like this, okay? So you got to be aware. You don't want to be buying 700. Even if your account is small, guys, buy something above an even number like this. Okay, go with 705. Sometimes you have an option to buy, like, let's say something like this, which would be like 707 and a half, 710, right? So pick a strike above 700, because oftentimes a stock will touch an even number like this and it'll bounce out if you're short, right? Oftentimes, if you're long, right, so let's say you have, let's say we had a reverse of this picture, and let's say we had 800. At 800, and I can't draw. Let's say we had 900, right? And so don't buy 900 calls, okay, because you could come up right to that and couldn't break the level, depending on, you know, what a longer time frame chart shows, and then it drops. So don't be selecting these strikes. Always go just slightly under. If you're bullish, always go slightly above. If you're bearish, okay, and, you know, the number one thing, guys, I'll probably devote a separate video to this, okay? You should understand this. Whatever your calculations are where the stock is going to drop, you should never, ever. So let's say, in this case, I was actually thinking that based off what I was looking at, the calculations, that BlackRock could actually drop to 695, okay? And looking at this situation right here, after the earnings announcement and this bounce, notice, I didn't want to buy the 695 put. And the stock actually dropped just a little bit. Like, it got to 695 there today at like 2 o'clock, and then it dipped at the end just a little bit lower, 689. But my calculations were basically calling for a 695 strike, 695 target price. And my strike price that I wanted to go with was 720, 715, 710 puts. Okay, the reason is because your strike has to be, if you're trading puts, it has to be above, it has to be absolutely above your target. Okay, it has to be above your target price. So basically, all things even, when the stock drops to your target price, by that moment you want to be in the money. You want to be in the money. So the 720s, when we were entering these, they were going for 5.5. Okay, 5.5. You could have bought them, and so my calculation was we're going to drop within 48 hours to 695, and so that would have produced a 4x trade because you would have been able to sell them, and almost a 5x trade. So $25. So you go from buying them for 5.5, you sell them for $25. That is almost a 500% return, guys. Okay, so basically 5K in this trade would have basically gotten you close to 25K within 48 hours. And this is an alert that we send out, guys. You could have taken this trade. Anybody could have done it. So if you're not a part of the alerts, guys, sign up. I don't have time to talk about it. Just make sure that when you sign up, you take some courses, because you've got, like, look, the guys that you're going to talk to, that will talk to you about the alerts, they're not even going to let you sign up unless you've taken some of our courses. Because, look, chances are, okay, if you would have taken the alert and you would have seen what the stock is doing this morning, right? What the stock was doing was the exact pattern. Like, the exact pattern that's been doing almost every fucking day. But if you weren't paying attention, you would have not known. So what does the stock do? It gaps up. So I mean, all the guys are like, oh my God, Leo, it's gapping up. I got this 720. This shit expires today. What do? Do nothing. Do absolutely nothing. Stick to the fucking plan. That's what you should do. Okay? But there's a pattern here. Pop, drop. Pattern. Pop, drop. Pop, drop. Bounce, drop, bounce, drop. Why should today be any fucking different? It's a bounce and a huge fucking drop today. Okay, that's how you get paid. But what would you have done if you didn't take any of our courses? You would have jumped the fuck out. And you would have not made all this money, guys. You would have missed out on all this money right here. Instead of making close to 25K with just 5K, what you would have ended up, you would have invested 5K, you would have cashed out maybe 3K. All right. Let's move to the next example, and after this. So, understand this. Let me just summarize this. Less is more. Okay, in majority of trading conditions, less is going to be more. Okay, less is going to be more, meaning 720 strike put is going to make you more money than 3 strike of 700 put. Okay, and in this case, it would have been okay, right? Because we did drop $11 under the 700, but let's say it would have stalled out here, or it would have stalled out here and it would have bounced, guys. Your whole trade would have been blown. Okay, your whole trade would have been blown. But in a 720, 715 strike, you would have had the liberty and less stress to actually stick with the entire trade. Because guess what? Even if it would have bounced right here to 705, guess what? These 720 puts or 715 puts, they would have still been worth 15. There's no way you would have basically lost the money. That's the point. You would have definitely made some money. You would have not gotten rich or paid for your house with this trade, but you would have made money. Easy. Now, in 700, it was a dice. It was a dice, and based on what the rest of the sector was doing, guys, I mean, that was just not an ideal strike. Understand that. So, less is more, meaning one put of 720 would have made you a lot more money than 3 puts in a 700 strike. Okay, so less contracts with better strikes, given certain market conditions, will produce much better results than many contracts with a bad strike. Bad strike when, how do you know when a strike is bad? Well, the strike is bad when an average move in this stock at this point, based on what the sector is doing, percentage-wise, would be $20, $30, okay? And you're buying a strike that is like $40 out of the money. Okay, see, any strike that would have been, within $20, $30 under this entry would have made you some kind of money. But if you went with, 685 or 680, yeah, you were right. The stock would have dropped, and it did, but you would have not made nothing. Here's a huge psychological challenge. And this psychological challenge is, a lot meaningful and somebody that's working with a smaller size account, guys. So if you work with a smaller size account, guys, you're always going to be tempted to buy many contracts that are cheap, that are out of the money, okay? And again, there's nothing wrong with doing that if you understand the market conditions, if you understand the catalyst. There are definitely certain times when you absolutely want to do this, because that's what market is about. Market is not about trading safe every day. Market is not about buying calls, puts in the money, deep in the money all the damn time, okay? There's certain conditions that favor doing so. There's also certain conditions that favor you going way the fuck out of the money, because that's the stuff that could produce 20, 30, 50x trade at times. So you'll be tempted to buy contracts because mainly they're cheaper in price. If you're looking, if you're working with a small account, you're going to be tempted these contracts because they're priced cheaper. So let me give you a good example. This is the trade we've taken today. Now, guys, this is the trade I said, short the hell out of travel stocks. The whole world is falling apart. Deglobalization, guys. I'll put a video on deglobalization here in the next few days, but understand this. Okay, all the analysts are fucking wrong. You could listen to them, and you could say, well, Leonardo, but, all these travel stocks, they're going up. Okay, when do you short stocks? When do you want to short a stock? You don't want to short a stock when it's been dropping for days and days and days. You want to short a stock when it bounces. Or on the move, too. You want to catch a 2-3 combination. If you don't know what a 2-3 sequence is, guys, no wonder you've never put a trade like a 10K to 150K. So understand that this is an easy trade right here. So when this morning it bounced, we said, hey, buy 2280, 2270 puts. Now notice, I didn't say buy, 2220 puts, or didn't say buy 2200 puts. I didn't say buy 2160 puts. None of that stuff, okay? I said, listen, there's a good opportunity that overall between the 2 days we're going to get a move 11, which is exactly what we've got. We got an 11. Overall today was a 2. Every bounce was to be shorted. This was a beautiful thing, okay? But I specifically said 2270s. 2270s. And for some guys with small accounts who were coming in after this plateau right here in the stock, I suggested buying some 2240s, 2245s. Listen, I didn't want to go way out of the money. When you trade certain stocks, they're going to come with certain spreads. BKNG is a stock that's got freaking high spreads, okay? So the one reason in this case to be buying contracts that are closer to the money, in this case like 2280, 2270, is because you're going to get a slightly lower spread, okay? And so automatically you're going to put yourself in a much more advantageous position, because some of these that are like way over here, they're priced like $1 bid and like 4.9 ask. That's the kind of stuff that you're going to see in stocks. Now, that's not a bad thing. You're going to see this sort of thing in stocks that, let's say, biopharmaceutical stocks. You're going to see it in stocks that don't trade on huge volume. Like BKNG does not trade on huge volume. It trades like 200,000-300,000 shares per day on average. So when BKNG trades like 500,000-600,000 shares a day, like that's a huge payday, because, if you got the direction right, you're going to get paid beautifully. Okay? But most of the stuff, because the traders that buy and sell options on a name like that, they understand that at any given moment, this thing can fall the fuck out $50. It can also go high $50. You got beautiful examples of that right here, right? Here it is, $50 move higher. Here it is, what did it do today? $32 lower, but we've caught it while the stock was still up, like $10, $20 up. So we've caught that $50, $60 move lower. And guys, this was an 8x trade, depending exactly what field you got and, stuff like that. But understanding this overall move, that's key. Understanding that you're better off going closer to the money into a stock like this is important. And, in this case, we're expecting BKNG to fall the hell out Monday, next week. Look, BKNG can easily hit like $1,800 in the next month, okay? A major part of this drop could come like Monday. So it would have been a really good trade, right? Especially if your account size is right. This is And you can put $50,000 in a trade like that. Monday you would have been at $250,000. I'm like, this is a no-brainer trade. Okay, but if you're working with a smaller account, you try to trade weekly options, same day expiration kind of thing. And this was an 8x trade. Okay, so it drops all the way down here to like 22.16. Where we're getting in right here, guys. It's a 60-70 point drop that we've caught on just. This is just an easy trade. And what makes it safe is the fact when you're buying closer to the money, you're getting a better fill. Okay, and no matter what, okay, yeah, if it continued dropping today, I mean, these lower strikes would have made a lot of money. But these strikes, guys, based on what the rest of the travel stocks were doing, right? You had some other bullshit like Marriott was up like 5 days in a row. You got stocks like RCL up. You got bullshit like Airbnb up. Okay, all these stocks, they're dog shit in these market conditions. They are about to drop. So what you want to do is you want to short the bounces. People don't understand. Oh, Leonardo, you said you're bearish on travel stocks. Fuck yeah, I can't wait till days like this when they bounce so I can short the hell out of them, because that's what makes you money as a short seller. Okay, you got to short stocks while they're going higher. On lower one, look at this chart. There's like no volume on this chart. You got to short these low volume days when stocks are going higher. Okay, I promise you that's what institutional investors are doing. They're putting up the story on CNBC and Bloomberg saying, oh yeah, buy the hell out of travel stocks. What are they doing? They're shorting the fuck out of them. I promise you they shorted the shit out of travel stocks today. And that's why Monday, you're going to see a huge collapse in travel stocks. I mean, some of these stocks are going to be down 5-10% on Monday. Okay? And so, as a trader, you can't be looking at what's happening yesterday. You can't be looking at what's happening today. You got to be looking, okay, what's the next move? What's happening tomorrow? All right, so enough of this. Let's let me summarize this. So they're different market conditions, okay? Meaning certain sectors are more likely to move. Okay, like for example, the Chinese stocks were down today, but they weren't down that much. And somebody asked me a question, should I short BIBA? Yeah, BIBA is a dog, but you should have shorted that yesterday, not today when it's already down 4 points, right? So you got to position yourself ahead of the move, all right? And overall, yeah, we're still bearish on Chinese stock. Deglobalization, god damn it, deglobalization, that's what's going to get you paid. If you understand the concept of deglobalization, you're going to stand a chance to make a ton of money in the next few years here. In most of the cases, like I just shown you, like the BKNG trade, it's justified to be buying in the money, close to the money, okay? Because overall, what is the market going to do? It's not going to move huge. Like, it's not going to be a collapse in the market every day. It's not going to be a collapse in the market every week. So, you don't want to be going with way out of the money stuff. This is just a simple, basic explanation, okay? But in everyday type market, what's really going on, you're going up one day, you're going to drop one day, up one day, drop one day. You're really not going anywhere. You're going sideways, and that's about 65% of the market, okay? So if you want to advance your account substantially, okay, like 10x, 20x, 30x, okay, what you really want to do is you want to utilize the strategy of buying options out of the money, way out of the money, when you have clear understanding of the move, whether it's a move 1, a 2, a 7, or a 13, okay, and when you can clearly understand the underlying catalyst for the move. So I'll break this example down, guys, and listen, get ready for next week. It's going to be phenomenal. Next week trading is going to be phenomenal. So BCYC, I mean, most of you have never heard of this. I mean, you're like, how the hell, Leo, did you find this? Well, you would have found this if you were trading with me. If I was your coach, you would have found this if you were trading with some other coaches here at 13 Market Moves. Guys, this is 17x trade. Now, the beauty of this trade is anybody could have taken it. You could have committed like almost no resources to the trade, and you would have still made huge. Okay, you would have paid for your fucking car this week. I mean, you got a $50,000 ride. All you had to do is put $5K in this trade. Your car would have been paid for. I mean, it's that simple. Okay, you don't have to be a genius to take trades like this. You just got to understand the move. You got to understand, like, hey, I got to do this. I got to pull the trigger now, because the guys were pulling the trigger on it after the drop. Like, it was too late. You don't want to short stock, when it's already dropped. But clearly, this is some kind of biopharmaceutical company, okay? Clearly, Like, listen, guys, I'm telling you, I don't care to study the exact report, because studying the exact report of whether the company is doing good on their, research or not, this is number one. Okay, this is not what's going to help you make the money, because the market is going to determine whether the research of this biopharmaceutical company is good or bad or whatever. Okay, it may be good and the stock could still dump. Okay, but anytime you deal, I can tell you this, with a phase one, okay, and phase one does not look good, well, I tell you, you don't have to be a rocket scientist to figure this shit out, that the entire company is doomed. Okay, you can't even have good results on phase one. How are you going to get to phase two, phase three, phase four? I mean, forget about it. It's over. Okay, so you look at a long-term chart, you see the stock is up from $10 to 50. Now you got to short the hell out of it. And even if you missed this initial drop, which was pre-market, when the stock opened, it opened right about 30. We waited for the bounce. I told you in the alert group to short the hell out of this thing in buying what strike? The 30 strike. But also, if you were working with me individually, I also told you to buy right here this 25 strike, especially if you didn't have a $500,000 account. I told you to buy this strike right here, 25. When I send out the alert to buy these, okay, this a $30 strike, they were going for $1. Actually, some of you guys got it for like 80 cents. So $1. And if you would have stayed with the trade 48 hours, guys, 48 hours, that's all it took, 48 hours, okay? The 30 strike that you were buying for $1, just under, okay, they were worth as much as 8.5, so that was an 8x trade. Now, here's the kicker, okay? You would have had a 17x trade if you bought the 25 strike, because when I send out the alert, and I personally, with my personal students, I send you the message to get these 25 strike. Those 25 strike guys, they were going for 10 cents and 20 cents. So let's say you didn't get filled on the 10 cents on these. Let's say you got filled on 20 cents. Okay, they were worth 3.5, 3.4. You could have easily gotten filled right here, guys, at 3.4, 3.4 on the 25 strike. Okay, so this is a 17x right here. Guys, 17x. You could have bought the shit for 20 cents, sold them for 3.4. Okay? Look, you cannot find a penny stock that moves from 20 cents to 3.4 in a day. I mean, you can find some penny stocks that move from $1.02 to like 7, 8, but you're not going to find a penny stock that's going to move from 20 cents to 3.4 in 48 hours. I promise you. Okay, so, I mean, here's the deal. Guys, if you want to identify trades like this, I've got a sure thing for you. I mean, the way you do it is, because trading is my life. This is what I do. My coaches, this is what they do. Look, instead of sleeping, we prefer to look at charts. Okay, we don't like to study this bullshit, BCYC. I mean, who cares what this thing is? Okay, we're traders. We don't care what this thing does. All I can tell you is, have some common sense. Look at the damn charts. You can have a 17x trade if you understand the 13 market moves. It's a simple sequence. 2, 3, 3. That's all you have to know, guys. 2, 3, 3 sequence would have gotten you a 13x trade. 2, 3, 3. Now, if you don't know what a 2, 3, 3 sequence is, no wonder why you're not putting 17x trades together. So, guys, last psychological note for the day is, I've actually talked to somebody today. He's like a new trader, and he was like, well, Leo, we don't have to. I mean, we can't, listen, there's always another day. I'll wait till next week, okay? And I'm going to tell you that this mentality is just so dangerous, because this tells me one thing about the trader, okay? That trader does not understand the market moves. And also, he does not understand the options pricing. Okay? You make money in trading when just a few sets of criteria is met. One of them is options pricing. Your options pricing is going to be the best at or close to options expiration, which for stocks will be Friday. And if you're trading indexes like, SPY or Qs or whatever, I mean, they're going to expire like, Monday, Wednesday, Friday, so you got extra days for the same day sort of expiration. And so those are going to present your greatest options pricing. But you have to go for the kill on those same day expirations when you really understand the move, when you understand the move, when you can see it, when you've been following the market day after day after day, and you got a clear lead, and you're like, boom, this is it. This is it. Okay, so the market opened higher today, and what did we tell you to do? We told you to short the hell out of the market. Short, short, short. Buy puts, Amazon puts, okay, Tesla puts, buy puts all day long. We never send you a message today to buy calls, guys. Despite of the market actually opening high, despite of the market going high yesterday, we did not blink. We told you to stay committed to your put positions. If you did, you made a shitload of money, especially in the last 2 hours of the trading session. Okay, but this mentality is dangerous. Okay, Monday is not going to be the same thing as it was today, because Monday, the same option on Amazon that we're buying today for $4, okay, well, it's going to be $30 on Monday. So for you to just, based off your cost basis, okay, to have a trade. Today we have traders buying Amazon for $4 and selling it for $20. That's a 5x trade. Monday, okay, the options on Amazon are going to be like $30 roughly. Okay, depending, of course, on the strike and so on. Just averaging this out if you're trying to get sort of near the money or within $50 from the money. I mean, you'd be at $30, and that means Amazon would literally have to drop like $200 or $250 for you to have same 5x sort of trade. So you don't, like, not every day in the market is the same from the standpoint of options pricing. That's number one. Not every market day is the same, because clearly we've got, based on the 13 markets move formula, we've got about 90% chance of a gap down Monday. Gap down Monday. We're expecting oil to shoot up, commodities to shoot up, gold to shoot up. I mean, all of these things that are war related, they're going to go up. They're going to go through the roof, and the general market, okay, it's gonna tank. We could get a huge gap on Monday, okay? 100 points, a couple 100 points lower on Monday. I wouldn't be surprised. But if we get some low, like a 30-point drop, I mean, that makes a difference for some of you that don't have any options for Monday. But based off the sequence, guys, okay, it's too late to be entering certain trades on Monday, all right? You had to be getting in these trades ahead of the big move on Monday. You have to do it today. And so you cannot have this attitude, well, there's another day, there's not. Guys, your whole life goes by, and you're like, well, I missed this opportunity, I missed this one, I missed that one. Because market conditions change all the time. Options pricing change all the time. When you see it, you got to go for it. You cannot blink. You got to grab your balls. You got to go for it. You got to make shit happen. Okay? So if you want to learn more about this, I suggest you work with a 13 Market Moves coach, guys. The message of the day, get better, let's roll. 13marketmoves.com, schedule a call. Let's take you to the $1 Million Club this month. Not in the next 10 fucking years. Do it this month. Let's go.